So jointly controlled asset. In the last class we have completed JCO, jointly controlled operations, and illustrations for JCA also completed in the last class. Before I proceed with jointly controlled entity, let me finish up some theory aspects of jointly controlled assets. There is no separate legal entity, legal identity. A and B may have a property, plant, equipment. Okay, it has no legal entity like a partnership firm or company or any other LLP. Like it will not have any entity form. And controlled by A and B, common control. The venturer use this asset to derive some economic benefit to themselves. From this, A will also enjoy some benefit, B also will enjoy the benefit. Probably A may use this, B may let out and generate income, whatever it may be, or both. A and B may let out the common asset and generate the income. That may also be possible. Each venturer incurs separate expenses. So A incurs some expenses, generates income, and similarly B also. And expenses, the expenses incurred by A will be debited to A's P&L account. A's P&L account. And expenses incurred by B will be debited in their P&L account. Assume that A may use it for their purpose, B may let out for other purpose. For running this business, 2 lakhs spent, 2 lakhs will be debited by A's A account in their P&L account. Say 2 lakhs is the expenses. 1 lakh is for A's P&L account, another 1 lakh is for B's P&L account expenses. And then this is the expenses. Asset value being 10 lakhs rupees for the first year, 1 lakh rupees is depreciated. Then depreciation on the jointly controlled asset, 1 lakh, though it may be 1 lakh for the A's portion is only 0.5 lakhs and another 0.5 lakhs is debited here. Is that okay? A uses it. So definitely there will not be separate revenues generated here. As they are using, they may save the expenses. If A doesn't hold the PPE, they may buy it from outside or may get it in rental also. So now rent is reduced. Understand? Property, plant, equipment, especially this is a building. A jointly controlled building where ground floor occupied by A, first floor occupied by some X which is let out by B. Because of A, he himself occupies, he will not pay any rent. And B, no, he lets out this for some third party for a rent of rupees 3 lakhs per annum. So he simply records the 3 lakhs revenue here. By the first year end, the property, plant, equipment's WDV value being 9 lakhs. Okay, 9 lakhs. And the 9 lakhs is held by A and B equally. We assume either it may be equally or some other ratios. And how this is going to be shown in the P&L account of A as well as B. In A, expenses incurred for jointly controlled assets by A as well as depreciation for the assets. And of course, because of using the property for his own business, he need not to pay any rental expenses. There is savings in rent. Or if it is being the plant and machinery, they may now use the plant and machinery for the production purpose. Because of that, their revenue also increasing. But B doesn't use it for the requirement, their own business requirement, but it might have been let out to third party. Any income generated is credited in the book. Don't say here there is no income. Here there is income. Here instead of income, it is used by A himself. Okay, definitely because of the usage, he enjoys some benefit. Clear? Now in the balance sheet, to the extent of his share, 4.5 lakhs will be added as asset, property, plant, equipment, 4.5 lakhs. Similarly, balance sheet of B company also, they will include property, plant, equipment as asset to the extent of 4.5 lakhs. Is that clear? So expenses on jointly held assets are shared by the venturers. In their financial statements, venturer shows only their share of assets and total income earned by them along with the total expenses incurred by them. In their financial statements, venturer shows only their share of the assets. Okay, so only their share of assets in financial statement. So 50%, 50%, 60-40, then 60% will be shown here and 40% will be shown here. Since the assets, liabilities, income, and expenses are already recognized in the separate financial statements of the venturer, that consequently in its CFS, no adjustments or other consolidation procedure were required. So we are not required to do any other adjustments for the CFS purpose. Okay. Financial statements may not be prepared for the joint venture. Usually we don't prepare the financial statement for this joint venture. Okay. Although the venturer may prepare accounts for internal management reporting purpose so that they may assess the performances of the joint venture. Anyhow, they will prepare for the internal management purpose only. So here, this is the consolidated balance sheet prepared for understanding what is the value of the assets they hold. That's all. Okay, not required, but anyhow, they will prepare for their internal understanding. Difference between JCO and JCA. In case of JCO, assets being own assets. Own assets means that entity's assets. In JCA, jointly owned assets. In case of jointly controlled operations, A, B, joint venture. So A investors and B investors, with that investment, they will now purchase the asset. So now who is the owner for the asset? Joint venture is the owner of the asset. In case jointly controlled asset, A and B will be the owner for the joint owner. Okay, they invested to the extent of their own worth. And agreement for joint operations to earn income. The main intention of JCO is to earn income commonly and shared among themselves. But in case of JCA, jointly construct and maintain assets to generate revenue. Either it may be for generating some additional revenue or it may be used by one of the venturers, or both the venturers may be in need of that assets, mean they can construct and use their requirement purpose, right? Sharing of expenses and revenues are sharing. Here only expenses are going to be shared. Okay, because in case of joint venture with the JCO, they have the revenue also, expenses also. The difference between these two will be net profit. The net profit will be shared to A and B. In case of jointly controlled assets, they have the assets, all the expenses related to the maintenance and running and depreciations directly debited to their P&L account. There is no any revenue generations at all. Okay, rarely. In this case, only revenue is there. That revenue is not for A also, because the asset is for A. Usually, jointly controlled assets, no. We assume A and B both are in need of such asset. As both are in need of such assets, that may be considered as used by A and B only, not for revenue generation purpose, but for their requirement. Is that okay? Now, jointly controlled entity. Jointly controlled entity. Venturer creates a new entity, either it may be corporation or firms, for a joint venture business. Jointly controlled entity. A as well as B. A as well as B. A and B are the venturer or joint venturers. Okay. This new entity may be company or firm or LLP, some entity form. Each venturer contributes cash or other resources to jointly controlled entity. So A also contributes either cash or other assets as his own investment. Okay, asset or some expenses met by A. Similarly, B also does so. These contributions are included in the accounting records of the venturer and recognized in its separate financial statement as an investment in JC. In JC, so there is a separate financial statement. Okay, in separate financial statement, especially balance sheet, the amount invested in JCE will be considered as investment. Okay, Contractual arrangements for joint control over the economic activity of JCE also be there. Okay, to what extent A is controlling the JCE and to what extent it may be controlled or influenced by B also be available there. And now JCE purchases its own assets. With that cash and other things contributed by the venturers, JCE purchases their own assets, creates own liability and expense and does the sales and all. This particular jointly controlled entity is similar to the thing what you have learned in your foundation joint ventures account, similar. Or you might have studied in your college days. Currently in revised CA foundation book, we don't have this one. Joint venture chapter was removed totally. That topic will be similar to this model here. The net results by operating this JC, they will have their own P&L account. That P&L account usually called as joint venture. Okay, joint venture account. Clear? Now, here they will prepare P&L account like joint venture account like. All the expenses and income are posted here and profit identified that will be shared between the joint venture. JCE maintains its own accounting record. The main part is this JCE maintains their own P&L account as well as balance sheet. The amount collected from A and B seems to be investment like, and for A means contributions like. For A and B, it may be investment in the joint venture entity also like. Okay, jointly controlled entity. So they will prepare own accounting records, prepares and presents financial statements the same way as other enterprises. Okay, like others, how they prepare trading and P&L account as well as balance sheet. Similarly, here also it's going to be prepared statement of profit and loss, income statement as well as balance sheets. If balance sheet required. Now, A Limited, a UK-based company, entered into joint venture with B Limited in India, wherein B Limited will import the goods manufactured by A Limited, okay, on account of joint venture and sell them in India. Okay. So A, B, and both will join to form a new entity, joint venture, jointly controlled entity. Okay, A is the manufacturer, okay, and B imports it and sells in India. B will import the goods manufactured by A on account of JV and sells them in India. So B is responsible for importing and selling in India. A Limited and B Limited agreed to share expenses and revenues in the ratio of 5:4. All the expenses and revenue shared in this ratio. Whereas the profits are distributed equally. This is for distributing, sharing the expenses. In case of profit and loss, it will be shared equally. A Limited invested 49% of the total capital, but investment made by A being 49%, balance 51% we may assume invested by B, but has equal share in all the assets and is equally liable for all liabilities. In case of assets and liabilities, both the entities are equally eligible. In case of expenses, A spends 5 rupees and B spends only 4 rupees. In case of assets and liabilities, both will contribute 50-50. But when it's all about investment, A investors only 49, B investors 51. Maybe it's a legal restriction. So foreign collaborators should not invest in India 50%. In that case, they may reduce 1% lesser, so that even though it's reduced to 1, they will have the equal rights also in making the policies and decisions. Following is the trial balance of joint venture at the end of the first year. This is what about the joint venture. Joint venture. Their trial balance detail is given. Closing inventory was valued at rupees 1 lakh. You are required to prepare CFS. You are required to prepare CFS, consolidated financial statement. Okay. So you know that trading and P&L account and balance sheet and all, right? Very simple. So consolidated statement of profit and loss. Okay, and consolidated balance sheet. Consolidated balance sheet. Come on, tell me. Purchases. So we can prepare in vertical format. Sorry, we can prepare in vertical format. Consolidated P&L account. Statement of profit and loss. Consolidated balance sheet. Okay, you study the format along with the company's final accounts chapter, financial statement chapter, as per the schedule number 3. Now, purchases, main operating expenses, other expenses, sales, main operating revenue. Okay, then this is asset, non-current assets, current assets, unsecured loans, maybe non-current liabilities like current liabilities and capital. So we have been given only 3 items related to the income. Revenue from operations, the value being 9 lakhs. We don't have any other revenue, so stop here itself. And expenses, under expenses, we have purchases, material related expenses, purchases 9 lakhs, sales being 13 lakhs 5,000, 13 lakhs 5,000, purchases 9 lakhs, other expenses 3 lakhs 6,000. Okay, closing inventory was valued at rupees 1 lakh. Is there any opening inventory available? This is just now entered, or it is the first year, so definitely we don't have the opening inventory. Changes in inventory should be adjusted here. Initial inventory is 0, closing inventory is 1 lakh. If the closing inventory is higher, this reduces the expenses, so you have to subtract from the expenses minus item. So the ultimate value here being 11 lakhs 6,000, 11 lakhs 6,000. If I subtract the expenses, then you will be getting profit or loss, profit before tax or whatever it may be, 1,99,000. In case of consolidated balance sheet, number 1, equity and liabilities, consolidated balance sheet, equity and liabilities. Okay, how much is that? In that equity share capital, we assume this 4 lakhs 1,000 is the equity share capital, and we have been given non-current liabilities, value being 2 lakhs, and current liabilities 1 lakh, 1 lakh. Reserves and surplus, the profit what we have identified here, profit before tax, 1,99,000, 1,99,000. Is that okay? Then what is the total of liability side? Is it 9 lakhs? Second being assets, non-current assets 6 lakhs, and current assets 2 lakhs. We assume that stock is not included here, so I have to include the inventory here. the value being 1 lakh. Balance sheet is tally. But this seems to be pretty simple, but what you have to learn here is very, very important. This part is going to be incorporated now. C. C. What I am going to do. I am going to show all of them as notes to accounts like. Notes to accounts. Okay. So notes to accounts. I'll start with revenue from operation, purchases, other assets, other expenses, and inventory, 5 equity share capital, 6 reserves and surplus, which is nothing but PBT. Non-current liabilities 7, current liabilities 8, non-current assets 9, and current assets 10. Inventory number 4. Inventory number 4. This one is also equal to this one. Number 1 being revenue from operation. Revenue from operation. Find out the revenue for A and B separately. In case of profit or loss, revenue, whatever it may be, shared equally. Out of 13 lakhs, okay. Is there any other information for the sales? 5:4. Expenses and revenue, I think. Share this 13 lakhs 5,000 in the ratio of 5:4 ratio. Come on, make it faster. 7 lakhs 25,000 for A, 5 lakhs 80,000 for B. Such a segregation is going to be done. That's all. Only in the notes to account for all these things. The overall value being 13 lakhs 5,000. Second one being purchases. For A and B, 9 lakhs. Should be shared in the ratio of 5:4. So 5 lakhs and 4 lakhs. Third, inventory, closing stock. A and B. Closing stock is the asset, will be shared equally. In case of assets and liabilities, equally shared. 0.5 lakhs and 0.5 lakhs. And 4. Oh, third is other expenses. Okay. This is fourth one. Third one being other expenses. Expenses should be shared between A and B in the ratio of 5:4. The value being 3 lakhs 6,000. Share in the ratio of 5:4. 1 lakh 70. 1 lakh 36,000. Then fifth one, share capital for A and B. What about the total share capital? 4 lakhs 1,000. In case of share capital, it should be in what ratio? 49:51 ratio. Isn't it? 1,96,490. 2 lakhs 4,510. Sixth one, reserves and surplus. Reserves and surplus for A and B. Profit before tax being 1,99,000. Profit and loss shared equally 99,500. 99,500. Seventh one, non-current liabilities. Assets as well as liabilities both will be shared equally for A as well as for B. First, to finish up the SOPL as well as balance sheet, and then you can proceed the notes to accounts. Then the sum will be very easy. The overall value for NCL being 2 lakhs should be shared equally 1 lakh and 1 lakh. And eighth one being current liabilities for A and B, overall value being 1 lakh, 0.5 lakhs for A, another 0.5 lakhs is for B. Ninth one, non-current assets 6 lakhs, A and B 6 lakhs. Assets should be shared equally, so 3 lakhs for A and 3 lakhs for B. And 10th, current assets A and B, the total value being 2 lakhs. A and B will share this equally, 1:1 ratio. This is in consolidated form. Apart from that, for A's financial statement, they will consider this being the investment. A is about 13 will be shown as an investment, right? Clear? A will show to the amount invested in this joint venture will be considered as investment in joint venture, as well as B will also show to the extent of investment. Okay, the assets and liabilities will be considered here. Now we'll move on to the next one. Clear? So we'll deal this illustration also. A Limited entered into joint venture with B Limited on 1:1 basis, and new company C Limited was formed for the same purpose. Prepare balance sheet of A Limited and B Limited under proportionate consolidation method. Okay, proportionate consolidation method. Proportionate consolidation method is very simple. Okay, for A Limited investment in joint venture, so C is the joint venture. A as well as B invested in C Limited in the ratio of 1:1. The overall share capital in C is how much? 5 lakhs. Similarly, in case of A and B, investment in C will be 2.5 lakhs plus 2.5 lakhs. Okay. So you might have studied the consolidated financial statement the same way. You can merge all the assets and liabilities line by line. If you are clubbing these two, you have to club what? Okay. The assets and liabilities of C will be clubbed with the assets and liabilities of A, to the extent of half share, because 1:1. Another part will be clubbed in B, another half share. While clubbing this 5 lakhs and these 2.5 lakhs, 2.5 lakhs will be eliminated. Okay, you know that, right? So, while consolidation, investment is eliminated with the equivalent share capital. So, the worth of C Limited's equity share capital is 5 lakhs, and in case of A and B also, investment is equal to 5 lakhs, 2.5 lakhs plus 2.5 lakhs, 5 lakhs. There is no excess payment or underpayment. In case of excess or underpayment, of course, you can consider this being either capital reserve or goodwill. Okay, here equivalent amount. Now I have to do line by line addition. This 12 lakhs will be now merged with 6 lakhs here and 6 lakhs here. This 2 lakhs is merged with loans 1 lakh, 1 lakh. Okay, here 0.5 lakhs and 0.5 lakhs. Here 9.75 lakhs, 9.75 lakhs. And this will be 0.25 lakhs, 0.25 lakhs. That's all. So we have been given the balance sheet items. You can now merge. I just prepare A's balance sheet. You can prepare the B's balance sheet yourself later. Okay, it's very simple. Consolidated balance sheet of A Limited. Repeat the B Limited yourself later. So number one, shares, share capital, equity and liabilities. Equity and liabilities. Under that we have shareholders funds, equity share capital, reserves and surplus, non-current liabilities, current liabilities. Second being assets. Second being assets, non-current assets as well as current assets. Share capital being 10 lakhs. Resource and surplus being 24 lakhs. Non-current liabilities being 4 lakhs. Current liabilities being 4.5 lakhs. Non-current assets 40 lakhs 25,000. And current assets being 2 lakhs 25,000. If I tally, then you will get 42 lakhs 50,000. 42 lakhs 50,000 rupees. Yeah, of course, you can prepare a notes to accounts also. I just prepare for the reserves and surplus only. Rest you can do it yourself. Reserves and surplus. Under reserves and surplus, its own value, A Limited's value, 18 lakhs. Amount transfer from C Limited being 6 lakhs. Overall, 24 lakhs. That's how you can give the notes to accounts for all the clubbed item separately. This is for A Limited's consolidated balance sheet purpose. You can prepare the same way for the B Limited. It's very simple. To understand this, I have given this. Okay. Now, let's finish up some theory and other aspects. So, A is number 27, joint venture. We have three kinds here: JCO, JCA, and JCE. Okay. Provisions of AS 27 need to be referred to for CFS only when CFS is prepared and presented by the venture. Only in case of CFS, this will be required. If I am not in need of preparing the CFS, this AS number 27 is not a matter. You consider this being only investment. Only investment. C, AS number 13 as well as AS number 23. If you invest 25% in a company, then that will be called as business associate. If you invest more than 50%, then it is a subsidiary company. If you have invested anywhere between 20 to 50%, then it is called business associate. You have the influencing right over there. This investment will be shown as investment under AS number 13 when if CFS as per AS number 21 is not needed. If CFS as per AS number 21 is needed, then the same will be prepared as per AS number 23. Similarly, in case of joint venture also, this method will be applicable once we plan to prepare the consolidated financial statement as per AS number 21. Else, it's a merely investment only, merely an investment. Is that clear? Now, proportionate consolidation method. The consolidation is called proportionate consolidation. What we have done now. The assets and liabilities are line by line added to the extent the A company or B company holding in the joint venture. Okay. This method accounting and reporting whereby venturer share of each of assets, liabilities, income and expenses of a jointly controlled entity is reported in case of JC and as a separate line items in the venturer's financial statements also as a separate line item should give some line item like okay. Now contractual arrangement, there should be contractual arrangement may be written, okay, written contract, minutes of discussion between parties and all, okay. So while conducting the meeting they may record what the things discussed in the meeting, no, that is called minutes. And even articles of the concern or bylaws, okay, you can form in this way for agreement arrangement. That contractual arrangement should include activity duration reporting obligations. What are the things you are going to do in the manner of joint venture and for how long you are going to operate that. So all these things are going to be given in the contractual arrangement. And who is going to conduct this business, appointment of board of directors or equivalent governing body. So in case of company, okay, we can say this being the board of directors. Instead of a company, if you form a firm or LLP, we don't call this being governing body. Means a board of directors. You can have any other governing body. Capital contributed, sharing the profits and all will be arranged. Okay. So these are the cases we have discussed. Now, in case of CFS of venturer, in case of CFS, consolidated financial statement, what method we follow? Already we discussed the same. Proportionate consolidation method is going to be followed. Reporting whereby venturer share of each of the assets, liabilities are going to be included. Okay. Proportionate consolidation method is followed except the following cases. Investment is intended to be temporary as well as operates under severe long-term restrictions. Already we have seen no the same condition here because it's all about CFS. In case of CFS, though I hold more than 50%, I cannot sometimes control. At your final level, no, you'll study in detail. Okay. In final level, even if you hold 30%, still you may be called as holding company, other company will be named as subsidiary company. Only 30%. Even if you hold 70%, still you will be not considered as holding company. So it was nicely explained at the final level, which is dealt under Ind accounting standards as well as IFRS, not in accounting standards. We confine with accounting standards only. Is that okay? For example, so beautifully it is dealt. Company A and XYZ company. XYZ company has 100 shares where A holds 30 shares only. A holds 30 shares only. Now, my question is whether A being holding company. As per AS number 21, we say no, sir. But as per Ind accounting standards, check what about the 70 shares. 70 shares held by 70 investors, and each and every investors are residing totally in different locations. When they organize AGM, annual general meeting, A will be present, and plus only 20 investors from the rest will present. Now tell me how many voting rights they have. A will have 30 votes and 20 investors will have only 20 votes. Overall 50 votes. Out of that, A holds majority, like Indian government got elected. Even if you get 30% vote, you got elected. Okay, that's a competition, right? So the contestant who secured more votes will be the winner. A contestant secured only 30% or 25 percentage, 30% not turned up for voting. And some places no, only 55% voting is there. Out of that 55 percentage, only 20% held by winner, another being 19.5, another rest of the others are scoring around 29 percentage or 31 percentage. This will be by winner, this is the runner, and this will be for rest of the 20 or 25 contestants. Okay, so 31 for 20 contestant, around 1.5 percentage only. Naturally, who is the winner? Okay, 20% holder. Out of 100 votes, 55 votes only got voted, casted, and balance 45 not. The same logic is considered in case of holding subsidiary relationship calculations under Ind accounting standards. Whatever the things you study, I will tell you there. Forget about all those things. We will start fresh studies in final level, right? So that's all about the case here. Rest of the things are the same. Though I may hold 70 percentage, yet I will not be considered as holding company, because maybe this holding may be temporary reason. Sometimes later I may close all the 70 percentage. My intention is not to control. Similarly, I hold 70 percentage. I thought to sell, but because of the some restrictions, this company's share is now blocked to be traded in the stock exchange. So I cannot sell. What can I do? I am retaining this without the intention of controlling this. Then also will be considered as this is not holding company status. In that case, proportionate consolidation method is not required to be followed, which significantly impair its ability to transfer funds to the venturer. This is the case. In both the above cases, investment of venturer is treated as investment as per AS number 13 only. You no need to incorporate as per AS number 27. AS number 27 will be applicable only if you are going to prepare SCFS. Else it is not going to be prepared at all. Venturers should discontinue to use proportionate consolidation method. So they have to follow the proportionate consolidation method only year after year. They can stop consolidation when they lose the holding, or they want to sell, or whatever the earlier thing. The same ditto will be kept here. When it ceases to have joint control, or proportionate consolidation method no longer appropriate because of long-term severe restrictions. This one, and temporarily I am holding and I am going to withdraw my control. That so in these two cases, thereafter you don't need to use the proportionate consolidation method. From this, it is very clear. AS number 27 recommends proportionate consolidation method for incorporating the investment made in joint venture, where the company requires to disclose their statements under CFS, AS number 21. Else, this is not required to be coming under AS number 27 directly. You have to follow only AS number 13. Okay. From the date of discontinuing, the moment you lose the status, okay, what you have to do? Okay. Now, let's see. Interest in entities more than 50%. A and XYZ. A Limited, XYZ Limited, 100 shares. Okay. A has invested 51 shares. 51 shares, more than 50%. Okay, more than 50% share. Now A Limited should prepare what? CFS as per AS number 21. First point. If interest is anywhere between 20 to 50, interest is 20% or more but up to 50%. Investments are to be accounted for in accordance with AS number 23. Accounting for investments. Already told all these things. Okay. If A Limited invested in IJK Limited out of 100 shares, anywhere between 20 to 50% held. It is 50% or above, not exactly 50. 50 plus 1. Here exactly 50. Though I have exactly 50, I cannot control. The other opponent also holds 50%. Definitely the decision will be in stalemate. Okay. Now this will be incorporated as per AS number 21. This will be incorporated as per AS number 23. Okay. Now, suppose joint venture. What happens, sir? You have to follow what? AS number 27. The moment you lose the status or you no longer treat this being AS number 27 applicability, okay, you are losing this one. Automatically, for all other cases, investment joint venture is treated as AS number 13 only. If you don't have AS number 21, then automatically AS number 13 will be followed. For this purpose, the carrying amount of the investment at the date on which JV relationship ceases. At the time, see, you are selling, here you have 50 plus percentage. You sold some number of shares, then you lose your holding because of holding only 49%. The moment you sell the shares in A Limited and brings the shareholding in XYZ Limited less than 50, you are not required to follow AS number 21. Thereafter, you have to stop preparing as per AS number 27. You just directly go for AS number 13. When you plan to go for AS number 13, by the time, earlier to that, what will be the value you show in your books related to the investment in joint venture will be your investment value. Okay. So, for the purpose, the carrying amount of the investment and the date on which this joint venture relationship ceases to exist should be regarded as cost. Thereafter, that will be the cost. When you sell later on, if you are selling more than the cost, then it's gain less than the cost. It will be loss on sale of investment or profit on sale of investment. Is that clear? Now, following are the features of proportionate consolidation method. What's that? Okay. See, I already told you, know, your cost of acquisition of the share being 100. Okay, 100 lakhs. And net worth in that joint venture entity, okay, jointly controlled entity being 80 lakhs. What does it mean? You paid more than its worth. Then excess payment will be called as what? Goodwill. Or the net worth is 120 lakhs. What does it mean? 20 lakhs will be capital reserve. Is that clear? Now, stress is given an absolute substance over form always. That is, more importance is given to the share of venturers in the P&L account of the venture from the share of assets and liabilities rather than the nature and form of the joint venture. Okay. Substance over form. Okay. So I'll explain this later. Venturer share of joint asset, liabilities, expenses, income are to be separately added in the CFS account. Third, most of the provisions of proportionate consolidation method similar to AS number 21. AS number 21 are this one same. Right. Same reporting date should be there from 1st April to 31st March. If you follow CFS as per 21 for this period, 1st April to 31st March, for the consolidation of joint venture should also be for the same period. Else you have to adjust the period. Same policy will be followed, and assets and liabilities not be adjusted. Okay, should not be adjusted from the book value only be adjusted for the uniform accounting policies and principles. All the things what we have learned in CFS will be applicable here also. On the date when interest of JCE is acquired, you will get either goodwill or CR also be available. So goodwill is nothing but interest of venturers net assets of jointly controlled entity. This is what about this one. If this is lesser where your investment value is higher, then it is goodwill, else it is a capital. So an investor who do not have joint control in the entity will treat like AS number 23. They don't have the joint control, but influencing, then automatically AS number 23 will come. 100%, I can guarantee controlling that. Okay, then AS number 21 will be applicable. Jointly, I am able to control, then AS number 27 is applicable. But I can just influence AS number 23 will be applicable. But calculation part will be the same like consolidation financial statement. Now, what happens here? Similar to the things what we have learned in consolidation purpose. What's that? Venturer transfers or sells the assets to joint venture. You understand? Okay. So you might have studied that, right? What's that? Assets sold, stocks transfer, unrealized profit on unsold stock. Assets may be sold by holding up into a subsidiary company, vice versa, by adding the profit. While clubbing, then you have to eliminate that unrealized profit, right? The same logic will be applicable. The venturer should recognize only the portion of the P&L which is attributable to the interest of the other venturers. So that's the logic. A and B, A transfers A and B in the joint venture. A transfers their capital assets being 100 by adding 20 rupees profit as 120 to joint venture. Is that okay? Now, what is the profit for A? While integrating that, it is not 20. The sharing ratio of A and B being 1:1. He has to recognize only 10. Means the goods sold to B extent will be realized as their profit, A's profit. Okay. So the venturer should recognize only that portion of the profit and loss which is attributable to the interest of the other venturer. And suppose the joint venturer completely sold this asset to third party, then of course no problem, they can recognize. The venturer should recognize the full amount of any loss only when the contribution or sale provides evidence of the reduction in the net realizable value of the current assets. In case the asset seems to be definitely lost, then they can provide the full loss to be recognized in the joint venturer's book. Okay. So this what about sales? This is a reverse case, purchase case. So rest of the things are similar like, okay. So we'll try to solve one illustration for this purpose. Now, A and B establish a separate vehicle, that is entity J, wherein each operator has 50% ownership interest. So A and B, entity J, A as well as B, investors 50%. Okay. And each takes 50% of the output. So A has 50% ownership, B has 50% ownership. Whatever the J produces, the output, finished goods, is not going to be saleable but taken by A as well as B. A as well as B. On the formation of joint venture, A contributed a property with a fair value of 110 crores and agreed to contribute his experience over the years towards this venture, and B contributed equipment with a fair value of rupees 120 crores. So how much A contributed? 110. How much B contributed? 120. The carrying values of contributed assets being 100. So A's contributed assets value being 100, B's contributed value of the assets being 80. Okay. Now for A, how do I recognize? Okay, in the books of A, okay, We have to find out A's gain. You understand this as it is. A's gain in CFS. These two will have equal rates, 1:1. The assets in J being 110 and 120. 110 and 120. Okay. Anyhow, this is what about the fair value. 180 is nothing but carrying value in their books. In their books. Now, in A's book, you have to do this way. A's share in the fair value of B's asset. B's asset. What is the fair value of the B's asset? 120. What about the A's share here? 50%, 60. Similarly, A's share in the carrying value of A's asset. For the others contribution, you have to take the fair value. For my contribution, I have to take the fair cost, my own carrying value. My carrying value is only 100. Out of that, 50% is mine. So 50%. Okay. So the difference between these two is the gain recognized by A, like it should be named as A's gain in the books of CFS. Gain recognized by A. By A. You have to understand this one. You can have this format directly. Okay. Yes, make a note of it. Now, let's finish up the other theory. Reporting interest in joint venture in the financial statement of an investor. So that's what we have already discussed. Operators of joint venture. Payment to operators is recognized as expenses in cash, means consolidated financial statement. Joint venture may be operated by third party. Any payment made them to run the show, okay, either it may be board of directors or any other authorized person to take care of that. That is nothing but their own expenses can be debited to the pay and account, and you have to recognize the revenue as per AS number 9. That's all. So management fee, whatever the name may be, okay. And finally, you have to disclose. What are the things you have to disclose? If there is any contingent liability, and in that contingent liability, share of one of the venturer, and reason why it arises, all these things are going to be disclosed. Also, the venturer should disclose the aggregate amount of the following commitments. If there is any commitment, they have to express their own aggregate amount supposed to be payable, or any capital commitment they have should also be reported as a notes to accounts below the balance sheet. These are called disclosures, right? Is there any contingent liability? Anything arises, to the extent contingent liability arises, to what extent we are supposed to meet that, and what about the capital commitment from our side? So all these things are going to be disclosed here. Okay. Apart from that, you have to disclose in your separate financial statement as well as CFS. A venturer should disclose in its separate financial statement the aggregate amounts of each of assets, liabilities, income, and expenses also be disclosed related to the JCE case. So that's all about the joint venture. So from this, it is very clear, especially JCE, no, that will be as per AS number 27 to be reported only when you are falling under CFS under AS number 21. Clear? So with that, this AS number 27 is over. So with that, volume 2, 10th chapter over. We now move on to the next chapter in the next class. Okay, financial statement of companies in the next class.